Annual inflation in the December quarter accelerated to 7.8%, the highest rate since March 1990. The quarterly rate, it was 1.9%, up from 1.3% the previous quarter. Now, among the highest price rises during the quarter, travel costs and electricity. Domestic holiday travel and accommodation jumped 13.3% during the quarter, right in time for Christmas. International travel, 7.6% more expensive. Electricity, and this is partly due to an unwinding of a $400 electricity credit in WA, it was up by 7.6% as well. But all eyes will now turn to the Reserve Bank. It watches underlying inflation, the so-called trim mean. Now, that was up by 1.7% in the quarter and by 6.9% for the year. And that is clearly way above its preferred target range for inflation of 2 or 3%. Here's the Treasurer, Jim Chalmers, on what he sees as an unwelcome trend.
This is very high inflation by historical standards. There's no use pretending otherwise. It's unacceptably high. It's in line with the Treasury forecasts for inflation, and it's almost as high as the Reserve Bank's forecast for inflation as well. Now, this is likely the peak in inflation, but we won't know that for sure until we get the numbers for this March quarter that we're in now.
So is the Treasurer right? Will inflation follow the same trajectory as the United States, where it has been coming down, or has it peaked? Or is it becoming now entrenched? Well, Ed Boyd this week sat down with Stephen Miller, the advisor at GSFM, and asked whether investors are in good shape after last year's economic and market rollercoaster.
I think for investors it was, perhaps the worst year in most of their living memories. We talk about the 60-40 portfolio, which is 60% equities, 40% bonds, or let's say a portfolio comprised of just bonds and equities. It did poorly because bond returns did as bad as they've done for many decades, and equity returns did, pretty close to as bad as they've done for many decades. So it was very, very poor for investors that had just had a portfolio comprised of bonds and equities. Those investors that had probably diversified their portfolio a bit more, and looked at things like macro hedge funds, which had a good year, perhaps selected commodities had a reasonable year, may have done a bit better. But it's fair to say in general, for investors, it was an awful year. It wasn't a great year for the economy, but perhaps for the first time since the late 70s, early 80s, the reason it wasn't a great year for the economy is we had that, what we thought was that ancient mythical beast called inflation, rear its ugly head again. And I think therein probably lies the clue as to why it was such an awful year for investors, is that a lot of the investing community weren't used to investing in a period when inflation was high and, let's say, more persistent, had a bit more momentum than certainly central bankers and investors have been used to. So not good. The reason it wasn't good for the economy was because inflation was higher, and that might have implications for how 2023 unfolds.
Well, let's talk 2023. Are we starting to see an improvement with bonds and fixed income?
I think the answer to that is yes. And I think the reason we're starting to see an improved environment for bonds is that inflation developments in the US toward the end of last year, I think, were very, very promising. If we look at measures of the inflation pulse, which is generally a 3-month annualised measure of inflation, core was at 3.1 in December. I think the peak was about 8 back in June. That core was as low as it's been since March 21. And I think what we're seeing as a result of that is there's less pressure on the Fed, particularly after their very aggressive campaign of rate hikes in the second half of last year. So with the upper limit of the Fed funds rate now at 4.5%, it might get to 5, might not even get to 5, but let's say it gets to 5, which is more or less where the market thinks it'll get to. And by the way, it's more or less where the Fed thinks it'll get to. So there's not much more tightening to go. Bonds are beginning to anticipate that, so the peak in yields was back in October. They might have travelled a little bit too far in the short term, but I think investors now can look at bonds and say, hey, I'm getting a decent sort of yield, I can get decent sort of income, and I don't face anywhere near the same prospect as capital loss as I may have done 12 months ago in the face of what was going to be, as I say, persistent inflation. So yes, bonds are back. Decent yield, decent income. It might not be great, But, you're getting something, if you look at a US 10-year now, you're getting 3.5%. Sure, yields might edge up a bit from there, but not anywhere near in the same sort of dramatic fashion. So you're getting decent yield, decent income without the same prospect of capital loss. And even more so, you're getting a decent pickup in yields if you look at, in things like corporate bonds, where again, so long, and this is a big if, so long as the economy doesn't go into recession, you can expect even better income and better return from the corporate sector.
Yeah, just on the recession, what do you rate the chances of a global recession this year?
Look, I think the Fed has said it's around 50-50, for the US at least. I think that's a pretty good guess. I don't think it's baked in the cake, as some investors sort of seem to think. I certainly think a slowdown's baked in the cake. The Fed, for example, is, I think, projecting GDP growth next year around about 0.5%. That wouldn't be inconsistent with a shallow recession, say, through the year. I don't think that's inconsistent with their 50-50 call. I think that's probably a good place to start and then identify the risks around it. So, yes, there's got to be some prospect of recession. But if it's a shallow recession, and that's a big if, and that would be my best guess at the moment, I don't think that's going to upset what will be a markedly better year for financial markets.
The Australian inflation numbers obviously came out this week, but where do you see inflation going for the rest of this year? Is a chance inflation in Australia could be more elevated over the next 12 months?
Yeah, look, I think the Reserve Bank forecast was around about 6.5. That's trim mean. That's the trim mean. That's the one it focuses on. That was the year to December. That's not great, but at least it wasn't markedly higher than that. However, I'm probably a little more pessimistic on inflation in Australia. If I look at, high frequency wage and price indicators, things like, what we got from the NAB monthly survey, if I do sort of pulse measures based on the monthly survey, I get prices growing at double digits. Now, I'm not saying inflation in Australia is going to double digits. I don't believe it is. What it tells me is that even if the number yesterday wasn't too far away from where the RBA thought it was on a trim mean basis, I think the risks are it won't come down anywhere near as fast as the RBA have projected. And that might mean not only don't interest rates not come down, but there might be more tightening to come from the RBA than markets are currently contemplating. So I think the markets are seeing the terminal policy rate at 3.6%. It's currently 3.1. When the RBA meets on February the 7th, I think it's widely projected that they'll take that rate to 3.35. I suspect we might get close to something like 4 before we can be confident that the inflation beast has been, or the inflation dragon has been slayed in Australia. Now, 4 might be higher than where the market's going, but bear in mind, we're talking about the US going to 5. So Canada's already at 4.5 and likely to go higher. New Zealand's higher. So I'm not sort of talking again, a disaster by any means. I'm just saying the market's a little bit complacent, maybe a bit sanguine on where the terminal policy rate needs to get to in order to get inflation on a meaningful downward trajectory. And I'm not, based on the numbers that we've got, I'm not confident that we're there yet.
And has the Reserve Bank acted quickly enough over the past 12 months?
I think the corollary of that is, in my view, no. I think they've been way too cautious. I think they've underappreciated the inflation risk. They appear in some commentary to have this view of what I term Australian exceptionalism, that the wage environment and the price environment in Australia is, for some reason, less challenging, and I can't see the evidence for that. Indeed, some of the changes that we've had to wage-setting arrangements, I think, balance the risks the other way, that they may well entrench higher inflation rather than be grounds for thinking that inflation will just decelerate more quickly here, or inflation's not as big a challenge here. So, yes, I do think the Reserve Bank has been overcautious. I'm not saying they're wrong, I might be wrong, but I do think the Reserve Bank has been overcautious. And if you look at the evidence, like I referred to earlier, those high-frequency monthly price indicators that we get, those high-frequency monthly wage indicators that we get, they're saying that the Reserve Bank still has or they're implying that the Reserve Bank still has a fair bit of wood to chop, as I say, I think the flip side of that, or the corollary of that, is that the RBA were erred on the side of being too cautious last year, rather than being focused on inflation. And that in contrast to the Fed too, where the Fed did those 475 basis point hikes toward the latter part of last year. And that's because Chairman Powell said, look, if we let the inflation genie get out of the bottle, getting it back in implies a greater cost in terms of employment and activity than if we sort of tried to fine-tune it and land it quickly. That's because the Fed and the RBA, for that matter, should know they've got the tools to reverse any deep cyclical downturn or disinflation downturn. They're dealing with an inflation genie that gets out of the bottle is a lot more problematic.
Well, Stephen Miller from GSFM, thanks so much for your time today.